Welcome to the deep dive. Today, we're tackling something pretty ambitious, actually.
hmm
We want to synthesize what you might call the four pillars of financial success. We're talking mindset, uh, market mechanics, risk, calculated risk, that is, and asset strategy.
Yeah, the goal really is to build a roadmap, a foundational one, for generating truly substantial long-term wealth.
Exactly. This isn't about, chasing the latest hot stock tip or just settling for good enough. This deep dive, it's designed to cut through all that noise
Right.
and give you the fundamental rules and maybe just as importantly, the internal discipline needed for real, lasting financial power.
That's a great way to put it. We've pulled together material from, well, a pretty wide range of sources. Foundational philosophy on success, detailed analysis of asset valuation, portfolio theory.
And even the tax code advantages, which people often overlook.
Definitely. The aim is to hand you the blueprint for, let's call it financial sophistication, distilling the how and the why of making your money work for you.
Instead of that exhausting cycle of you just working for money.
Precisely. Getting off that hamster wheel.
So the core challenge, the thing that seems to stop most people, is bridging that huge gap. The gap between wanting financial freedom, that vision,
The aspiration.
and the actual reality of an executed strategy. Especially using assets we can understand, like real estate. So let's unpack this roadmap right now. Okay, let's start right at the beginning. The absolute foundation. It's a choice, really, that defines your whole financial journey. Our sources point to this critical split in strategy.
Yeah, it boils down to the path of earned income versus the path of unearned income. It sounds simple, but the implications are massive.
Explain that difference a bit more.
Well, earned income is what most people rely on. You trade your time for money, you work an hour, you get paid for an hour, you stop working.
Money stops. Simple as that.
Exactly. But the path of unearned income, that's where your assets, your capital start working for you. Your investments generate returns, dividends, rent, whatever it is.
And that income stream keeps flowing, whether you're sleeping, on vacation, or working on something totally new.
That is financial power. It decouples your time from your income.
And accumulating that capital, holding on to it, deploying it smartly. It requires power. But the sources define this power in an interesting way. Not military might, not inherited status.
No, it's defined simply as organized knowledge. That's the key.
Organized knowledge. So it's not about luck or brute force. It's about systematically knowing the rules of the game.
Absolutely. In finance, organized knowledge means understanding market cycles, tax laws, how to manage capital effectively. Think about it. Someone who understands depreciation and 1031 exchanges.
Right.
They have immense power compared to someone who just knows how to clock in and out. But that knowledge isn't enough on its own.
No, you need discipline to execute. Which brings us squarely to persistence.
Persistence, the engine, as you called it. But the sources are really clear here. Wealth doesn't just respond to wishes. Vague hopes get you nowhere.
It responds only to definite plans, backed by definite desires, and crucially, maintained through constant, unwavering persistence.
And it's not just some fuzzy motivational concept. It's actually a structured four-step process according to the materials we looked at.
Okay, let's break that down. Step one.
A definite purpose, backed by a burning desire for its fulfillment. Not just, I want to be rich. That's too vague.
It needs to be specific, measurable, like I will acquire a positive cash-flowing duplex in the next 24 months, something concrete.
Exactly. Step two. A definite plan expressed in continuous action. You don't just make the plan, you work the plan every day, even imperfectly.
Imperfect action beats perfect inaction every time. What's step three?
A mind closed against negative influences. Period. This is huge. You have to actively shield yourself from doubters, from negative news cycles, from toxic financial advice.
Build a mental fortress.
You got it. And step four, often overlooked but maybe the most critical.
Let me guess. Accountability.
Bingo. A friendly alliance. One or more people who encourage you to stick to your plan. A mastermind group, a mentor, a partner. Someone who holds you accountable to your own defined desires.
That makes sense. Moving from that external support to our internal wiring, habits. Success seems to hinge massively on the habits we build.
It really does. And building any habit, financial or otherwise, follows this clear four-step loop. Cue, craving, response, reward.
Cue, craving, response, reward.
By understanding that loop, you can actually engineer it, break down bad habits, build good ones, systematically shift your default behaviors towards achieving your financial goals.
But there's a catch, isn't there? A big psychological hurdle that trips most people up when they try to stick with something long term.
Ah, yes, the plateau of latent potential. This is where most people give up.
The danger zone. Paint a picture of that.
Okay, imagine you start saving aggressively, or maybe investing small amounts consistently. For the first year, maybe 2 years, you're putting in the effort, right? $100 a week, maybe.
Yep, doing the right things.
But your account balance barely budges. The compounding effect is tiny because the base is still small.
Yeah.
It feels like you're failing. You're doing the work, seeing almost no visible results.
And the temptation to quit is enormous.
Exactly. That's the plateau. The critical insight is that results are often delayed. They lag behind the effort. Sticking with the habit through that plateau is what allows the compounding to finally kick in. Suddenly, the growth seems exponential.
Surviving that initial period of invisible progress is key. I like that. And the payoff for establishing these core habit-saving, budgeting, focused work is huge mentally.
Absolutely. When the basics are on autopilot, your mind is freed up. You're not constantly battling willpower fatigue over small decisions.
Right. You can focus your mental energy on the bigger picture. Complex challenges, like structuring a major deal, instead of getting bogged down in daily stuff.
That focus naturally leads into managing our most precious resource, time.
The sources are really emphatic about this. Time is the most valuable resource, more valuable than lost money.
You can always earn back money. You can never get back lost time. A minute spent is gone forever.
So successful people treat their time like the asset it is. They guard it. They structure it. Which brings us to things like time blocking.
Yeah, if you want to ensure those key high-leverage actions actually get done, analyzing a deal, making those calls, strategic thinking, you have to block out dedicated time for them. Non-negotiable time.
It sounds rigid, but it's effective. Though, interestingly, the sources also mention a contrasting idea.
Right, the idea that not everyone thrives on perfect order. Some successful people, especially in sales or crisis management, actually seem to thrive on chaos.
Yeah, they see chaos not as a problem, but as a source of opportunity, of sales leads.
It's a fascinating contrast. It suggests the real goal isn't necessarily perfect calm, but intentional focus. Whether your day is rigidly structured or you're riding the whirlwind.
It's about directing your actions deliberately towards that definite purpose you said earlier. Makes sense.
Okay, so we've talked about the internal mindset, the habits, the focus. Now let's shift to the external world, capital markets. Before you put your money to work, you need a solid strategy for valuing assets. Something better than just hope and guesswork.
Or as Benjamin Graham put it, hope and prophecy. We need to move beyond that.
Exactly, and this is where we see a major historical split in investing philosophy. On one side, you have the technical analysis folks.
The chart readers.
Right. Their first principle is pretty radical. They believe all the fundamental information about a company, earnings, prospects, management, everything is already baked into its past market prices and trading volume.
So the chart tells the whole story, according to them.
Essentially, yes. And their second principle follows from that. Prices move in trends. If a stock is going up, they figure it's likely to keep going up, for a while at least. Market momentum, herd behavior, that kind of thing.
They're looking at patterns, not balance sheets.
Correct. But then you have the other camp, heavily influenced by Benjamin Graham, the father of value investing. He was, well, let's just say, highly skeptical of technical analysis.
He called it fortune-telling and chart reading, didn't he? A bit dismissive.
He was. Graham believed the true investor needs to know what the company is actually worth. Its intrinsic value, determined by tangible things. Assets, cash flows, the balance sheet.
Not just the squiggles on a chart.
Precisely. And this philosophy is the bedrock of the intrinsic value strategy. It's often described as basically gambling, but only when the odds are overwhelmingly stacked in your favor.
You're looking for that margin of safety. Minimize the downside risk while maximizing the potential upside.
Exactly. The practical advice that flows from this is look for assets, stocks, businesses, whatever, that have good track records, maybe average future prospects, but are trading at a price much lower than what that business would be worth to a private owner.
You're essentially trying to buy $1 for 50 cents. Hunting for value, not just chasing what's popular or hot right now. Because popularity often comes with inflated risk.
That focus on risk mitigation leads us directly to diversification. This is one of the clearest, most established principles in portfolio management.
Right, the idea of not putting all your eggs in one basket. But how does it actually work with risk?
Well, the key finding is that as you add randomly selected securities to a portfolio, the total risk starts to decline. Specifically, the unsystematic risk goes down.
Unsystematic risk. That's the risk specific to one company, right? Like
Yeah.
the CEO scandal or if a failed product.
Exactly. Stuff that hits one company but not the whole market. Diversification washes that specific risk out, especially when you first start adding stocks. The effect is strongest initially.
And our research highlighted a specific number here, almost like a magic number for diversification.
Yeah, the 30 security rule. It's a rule of thumb, obviously, but the data supports it pretty well. Once your portfolio holds around 30 randomly selected securities, a huge chunk, a good deal, as the sources put it, of that unsystematic risk is effectively eliminated.
So adding more stocks beyond that, like 50, 100, 200,
It yields very little additional risk reduction. The curve flattens out dramatically.
that's incredibly practical for the average investor today. You don't need to pick 30 individual stocks yourself.
Not at all. You can achieve that diversification instantly and cheaply through broad market index funds or ETFs. Once you hit that threshold, your portfolio's ups and downs basically mirror the overall market. You're left mainly with systematic risk.
The unavoidable market risk, inflation, recessions, geopolitical events, stuff that affects everything.
Right. You can't diversify that away.
Okay, that makes sense. Now let's talk about how prices actually behave over time.
Huh.
There's always this debate. Momentum versus reversion to the mean. What does the evidence show?
It depends heavily on the time horizon you're looking at. For very short holding periods, think weeks or months, there is some evidence supporting momentum.
So a stock that's been rising might have a slight tendency to keep rising a bit longer.
Yeah, there's some statistical backing for that, which gives a little validation to the technical view, at least in the short term.
But what happens when you stretch that timeline out, 5 years, 10 years, 20 years?
That's where the picture flips entirely. Over longer holding periods, the dominant pattern appears to be reversion to the mean.
Meaning extreme performance, either way up or way down, tends not to last.
Generally, yes. Periods of massive outperformance or dramatic underperformance are often followed by a move back towards the long-term average return for that asset class. Extreme results tend to be temporary over a long enough view. This really rewards the patient, value-oriented investor.
Okay, let's ground this discussion with some actual numbers. What were the projections for equity returns based on the 2018 data we looked at?
Right. That 2018 snapshot gives a realistic baseline. At that point, the dividend yield on the S&P 500 was quite low, actually under 1.9%.
Okay, and then you add expected earnings growth to that.
Exactly. If you assume earnings can grow around 5% annually, which is, a reasonable long-term assumption with moderate economic growth and inflation,
You combine the dividend yield and the earnings growth,
and you get a projected total return for equities of just under 7% per year.
just under 7%. That's important because it's actually quite a bit lower than the historical long-term average, isn't it?
Mm-hmm.
Which is closer to 10% since the 1920s.
Precisely. That realization that future returns might be lower than historical ones really underscores the need for persistent, disciplined saving.
That 7% versus 10% makes a huge difference over decades. It means you can't just rely on heroic market returns to do all the heavy lifting.
Absolutely not. The sources illustrate this really well. Even saving a small, consistent amount, they use the example of just $23 per week through something like a 401k.
And letting it compound, even at that potentially lower 7% rate, still builds up to substantial wealth over a working lifetime.
The real payoff comes from the consistency of your contributions, month after month, year after year, not from trying to time the market or waiting for some magical surge.
All right, let's pivot now from paper assets, stocks and bonds, to something more tangible. Property, real estate. While the stock market is complex, liquid, real estate often feels, well, more foundational.
It really does, and one of our sources makes this incredibly powerful declarative statement. Real estate is the basis of wealth, just flat out.
The basis of wealth. Why such a strong claim? What makes it so fundamental?
Well, it comes down to its predictable performance and its inherent utility. Unlike a stock certificate, a house provides shelter. It serves a basic need.
And it generates income, right, when you rent it out.
Exactly. Houses produce income. And critically, the historical track record for both rents and house prices is incredibly strong. They tend to increase over time. House prices, historically, have gone up at an average annual rate of around 5% looking at long-term data.
And it's also known for being a pretty good hedge against inflation, isn't it?
An exceptional one, actually. Think about it. In an inflationary environment, what happens? Rents tend to rise, which boosts your income stream as an investor.
Yeah.
At the same time, the value of the underlying asset, the house itself, is likely appreciating, often faster than inflation. And there's a feedback loop, too.
What's that?
Rising home prices make it harder for people to buy, so more people are pushed into the rental market,
Which increases demand for rentals.
further pushing up rents and strengthening the landlord's position. It's quite resilient.
But the real magic, the thing that unlocks serious wealth potentials for ordinary people, seems to be leverage.
Oh, absolutely. Leverage is the superpower of real estate investing for the average person. It allows you to borrow significant amounts of money at an interest rate that's typically lower than the return you can reasonably expect to make by investing that borrowed money in the property itself.
Yeah, think about it. Where else can an average person walk into a bank and get, say, $400,000 for 30 years at maybe 4% or even less, with the property itself being the main collateral?
It's pretty unique. Lenders see real estate loans as incredibly safe. The asset is physical, you can insure it. People always need a place to live. This access to cheap, long-term debt is how regular folks can build wealth at rates that were once only possible for the very rich.
Okay, so leverage is key. What about actually buying the property? There's that old saying.
You make your money when you buy, yes.
Sure.
And it has a double meaning, really. First, obviously, finding a property that's priced below its actual market value, getting a good deal up front. Second, it's about timing. The absolute best bargains are often found when the market is not hot.
When prices are flat or even falling. When it's a buyer's market.
Exactly. When sellers might be desperate, maybe facing foreclosure, or when speculators who got overextended need to unload properties quickly. That's when you can find deep discounts.
That makes sense in a cool market. But what about in markets that feel overheated, like many places today? Deals seem impossible to find.
They're harder, no doubt, but you still need to hunt for value. And that means you have to go off the beaten path. You can't just rely on the MLS listings everyone else sees.
So this requires more active strategies, trading time for information.
Precisely. Strategies like driving for dollars. Literally driving around neighborhoods looking for properties that look vacant, distressed, poorly maintained. Signs the owner might be motivated to sell.
And the other one, cold calling landlords.
It sounds awkward. It can be. But think about it. You're directly reaching out to owners of rental properties, asking if they'd consider selling. Many won't, but some might be tired of being a landlord or facing some other pressure.
It's about generating your own leads, creating opportunities others don't see.
Right. And someone might hear driving for dollars and think, wait, didn't you just say time is more valuable than money? But this isn't wasted time. It's a strategic investment in gathering unique information, organized knowledge about potential deals.
That's a good distinction. And it pays off. We saw that example in the sources, an investor finding a deal this way.
Yeah, a fantastic example. Through off-market searching, this person found a rundown fourplex for only $70,000. Put about $40,000 into fixing it up, actually converted it into 5 units.
Adding value.
And immediately had it appraised at $200,000. That's like $90,000 in equity created almost overnight. A huge return purely from proactive searching and smart renovation.
That's powerful. Now, for people who like the idea of real estate returns, but maybe not the idea of dealing with tenants and toilets, there are REITs, right? Real estate investment trusts.
Yep, REITs. They were actually created by Congress specifically for that purpose, to give small investors access to the benefits of owning large-scale, diversified portfolios of income-producing real estate, like owning a piece of a shopping mall or an office tower portfolio.
So similar benefits to direct ownership, but more passive.
That's the idea. But it's important to understand how REITs have evolved. The early ones, well, they sometimes had issues.
Like what?
Often they were managed by external companies that got paid fees regardless of how well the properties actually performed. So management's interests weren't always aligned with the shareholders.
Misalignment. That's never good.
No. The modern standard is much better. It demands internal management, where the managers are employees of the REIT, and much greater transparency. And how you value them has changed too. Smart REIT investors now focus heavily on the estimated net asset value, or NAV. Basically, what are the underlying properties actually worth if you sold them all today?
So back to that intrinsic value idea, like with stocks. Not just looking at cash flow metrics like FFO, funds from operations.
Exactly. FFO is important for cash flow, but NAV tells you about the underlying asset value. And historically, REITs have generally shown lower volatility than the broader stock market, which can make them a nice stabilizing element in a diversified portfolio.
Okay, so you've acquired the property, maybe using some smart leverage. Now the game shifts, right? It's less about financial modeling and more about operations,
Yeah.
managing the asset.
Totally. Owning rental property is running a small business, and as the sources bluntly put it, getting the house rented is the game, but crucially, rented to the right tenant.
This seems like where a lot of landlords stumble, gut feelings over process.
Oh, absolutely. Discipline and a systematic approach are critical here. You need a thorough application and screening process. Make a quantitative decision based on facts, not just whether you like the person.
What are you looking for, quantitatively?
Stability. You need documented job stability, proof of income, length of employment. You look for local family connections, which often means they're less likely to just disappear. And obviously, signs they avoid crime or drugs.
And the interview itself, the showing. That's part of the screening, too.
Definitely. How do they present themselves? How do they interact? One source mentioned a simple but powerful technique. Call the previous landlord, not just the current one.
Why the previous one?
Because the current landlord might just want them out. They might lie or omit problems just to get rid of a bad tenant. The previous landlord has no skin in the game anymore. They're more likely to give you the unvarnished truth.
That's clever. And you ask them that simple question.
Would you rent to these tenants again? The pause, the hesitation, or the immediate yes or no, that tells you almost everything you need to know.
And look out for red flags during the showing, too, right? Like the example of someone showing up in pajamas.
Haha. Yeah, that was an extreme example, but it makes the point. It signals a lack of respect for the process, maybe for rules in general. If they don't respect the interview, are they going to respect the lease or the property? Probably not.
Okay, but even with the best screening, sometimes things go wrong. You end up with a tenant you need to evict. This seems like a legal minefield.
It absolutely is. And the number one non-negotiable rule here, never resort to illegal self-help eviction tactics.
What does that mean, like changing the locks?
Exactly. Don't threaten the tenant. Don't physically remove them. Don't change locks. Don't shut off their utilities. Don't seize their belongings. Any of that stuff.
Why is that so critical? It might seem like the fastest way.
Because it's illegal and exposes you, the owner, to massive liability. Serious civil lawsuits, huge fines, even potential criminal charges. You must follow the precise legal eviction process defined by your local jurisdiction. No shortcuts. It's frustrating, it takes time, but it's the only way to protect yourself. That organized knowledge of the law is vital here.
Got it. Follow the legal process to the letter. Now, shifting back to the finances of managing rentals, how do you quickly estimate if a potential property will actually make money?
There's a great rule of thumb for that. The 50% rule.
The 50% rule, how does that work?
It's a quick way to estimate your operating expenses, excluding the mortgage payment principal and interest are separate. The rule suggests that roughly half, 50% of your gross monthly rent will likely go towards all other operating costs.
Like what kind of costs?
Property taxes, insurance, vacancy reserves, repairs, routine maintenance, maybe some utilities, all that stuff. So if a place rents for $2,000 a month,
You should budget about $1,000 a month for those operating expenses before you even think about your mortgage payment.
exactly. It's a quick reality check to see if the potential cash flow is even plausible before you dive into a deeper analysis.
That's super useful for initial screening. But just collecting rent and waiting for appreciation is kind of slow, isn't it? The real pros seem to create value.
They absolutely do. Relying only on passive market appreciation is leaving money on the table. Smart investors actively look for ways to force appreciation, to add value to the property.
What are some common ways to do that?
Often, the highest return comes from increasing the functional living space or usability. The classic example is converting a large two-bedroom house into a three-bedroom, maybe by adding a wall or repurposing an unused dining room.
And that extra bedroom translates directly to higher rent and higher property value.
Instantly. It can add hundreds to the monthly cash flow and potentially tens of thousands to the overall equity. Small cosmetic upgrades can have a big impact too, especially in kitchens and baths.
Like countertops.
Yeah, granite and quartz countertops used to be super expensive, but the price has come down a lot. They make a kitchen look much more modern and desirable for a relatively low cost compared to the perceived value increase.
What about cabinets? Replacing those seems expensive.
It can be, but you can often hack it. If the cabinet boxes themselves are solid, you might just replace the doors and hardware. That's what people mostly see, and it can give the kitchen a whole new look for a fraction of the cost of a full replacement. Maximize the visual bang for your buck.
Smart. Okay, let's talk taxes. This seems to be where sophisticated investors really gain an edge. What are the key strategies?
Two huge ones stand out: depreciation and the 1031 exchange. First, depreciation. This is absolutely critical. You must claim depreciation expense on your rental property every single year you own it.
Even if the property isn't generating positive cash flow, like if expenses already wipe out the rental income.
Yes. Even then, without exception, here's why. The IRS assumes you are taking the allowed depreciation each year, whether you actually claim the deduction on your tax return or not.
Okay, so what's the consequence if you don't claim it?
When you eventually sell the property, the IRS calculates your capital gain based on your original purchase price, minus the total depreciation you were entitled to take over the years. They call this recapture. If you didn't actually claim those deductions year by year.
You missed out on lowering your taxable income in those years, but you still have to pay tax on that recaptured depreciation when you sell.
Exactly. You lose the annual tax benefit, but you still face the tax liability at the end. It's purely leaving money on the table. Claim depreciation every year.
Got it. Non-negotiable. What about the 1031 exchange? That sounds powerful but complex.
Extremely powerful. It's a section of the tax code that allows you to defer paying capital gains taxes indefinitely when you sell an investment property, as long as you follow specific rules to reinvest the proceeds into another like-kind investment property.
So you can swap properties essentially tax-free, rolling your gains forward.
That's the gist. But the rules are incredibly strict, especially the timelines. You have two critical clocks ticking from the moment you close on the sale of your old property, the relinquished property.
Clock number 1.
You must formally identify potential replacement properties within 45 calendar days. Not business days, calendar days. Sundays, holidays, they all count.
45 days to identify. That's tight. What if you miss it?
The entire exchange fails. All your deferred capital gains become immediately taxable in that year, no exceptions.
Wow. Okay, clock number 2.
You must actually close on the purchase of one or more of those identified replacement properties within 180 calendar days of selling the original property, again, calendar days, or by your tax return due date for that year, whichever comes first.
So identify in 45, close in 180, miss either deadline, and you pay the tax.
Correct. And there's also a strict reinvestment rule. To fully defer all the tax, you generally need to buy a new property or properties of equal or greater value than the one you sold.
Equal or up in price.
And you must reinvest all the cash proceeds from the sale into the new property. If you take any cash out of the deal that's called boot, that cash portion becomes immediately taxable.
It sounds like you need meticulous planning and probably professional help to execute a 1031.
Absolutely. It's not a DIY project for most people, which underscores the final crucial point on the financial management side: documentation and avoiding audits.
Separate bank accounts?
Yes, absolutely critical. Keep your personal finances and your rental property business finances completely separate. Separate checking accounts, separate credit cards. Do not commingle funds.
Why is commingling so bad?
It's a nightmare during an IRS audit. It makes it incredibly difficult to prove which expenses were legitimate business deductions versus personal spending. And worse, if your business activities get flagged for an audit, commingled funds can open the door for the IRS to audit your personal finances too. Separation provides a crucial layer of protection. Now, to really understand why real estate, especially in cities, has been such a powerful wealth engine, and for whom we kind of need to look at the historical context. Some uncomfortable history, but it's crucial.
Right. The sources compel us to look impartially at how housing policy itself shaped opportunities, sometimes creating barriers.
Exactly. We have to talk about the history of residential segregation in the U.S. It wasn't just accidental. Explicit government policies, de jure segregation, were designed to create and maintain geographic separation based on race.
And the Federal Housing Administration, the FHA, played a big role in this.
A huge role, unfortunately. For decades, the FHA actively refused to insure mortgages in predominantly Black neighborhoods, a practice known as redlining. This systematically denied capital access and made it incredibly difficult for African Americans to buy homes at fair market values in desirable areas.
So it limited their options and funneled them into specific neighborhoods.
Yes, which created opportunities for predatory practices like blockbusting.
Explain blockbusting again.
Speculators would intentionally incite panic among white homeowners in changing neighborhoods, often using racial fear tactics to get them to sell their homes way below market value. Then, those same speculators would turn around and sell those exact same homes at massively inflated prices to Black families who had few other options due to the redlining and discrimination elsewhere. They were forced to pay a premium for housing that white families were fleeing.
That's just exploitative?
Yeah.
And the long-term consequences.
Profound and lasting, spanning generations. The data we looked at is stark. Neighborhood poverty is multi-generational for nearly half, 48% of Black families over 2 generations. For white families, it's much more likely to be episodic, affecting only 7%.
So being locked out of appreciating housing markets and concentrated in under-resourced neighborhoods creates a cycle.
Absolutely. It affects everything. Quality of schools, exposure to crime and stress, access to successful role models, job networks, all of which impacts future earning potential and the ability to accumulate wealth later on. It compromises wealth building right from the start.
And this history contrasts sharply with the dominant vision of American housing, especially urban housing, enforced through zoning, right?
Very much so. The typical American zoning tradition fiercely protects the single-family home. It reflects this deep-seated cultural preference, what the sources call a pastoral ideal.
A pastoral ideal, meaning like country living within the city.
Sort of. It's an ideal that values privacy, space, a detached home on a decent-sized lot, a private domain seen as immune from the perceived chaos and intensity of dense, collective urban life. Low density is often equated with quality of life.
This preference for space and separation has shaped our cities into sprawling, low-density environments, very different from older European cities.
Exactly. And it's not even a new trend. One source noted that some of Philadelphia's oldest neighborhoods actually hit their peak population density way back in the 1830s. The impulse to spread out, to seek distance, is a long-standing theme in American urbanism.
And it's this model, high demand for limited, low-density housing in desirable areas, that fuels modern property values, particularly in major cities.
Right. And now we're seeing this interesting demographic shift. For a long time, the middle class fled cities for the suburbs. Now
You see more affluent, educated, often younger, childless people moving back into the urban core. Why? Ironically,
immigrants and the working poor are increasingly pushed out to the suburbs, searching for affordability that no longer exists in the city center.
this reversal is creating intense pricing pressure, isn't it?
Yeah.
Threatening the ability of essential workers to even live in the cities they serve.
Precisely. The example given was Stuyvesant Town Peter Cooper Village in New York City. It was originally built after World War II as affordable housing specifically for middle-class working families, nurses, firefighters, teachers, a refuge.
And today?
Today, a standard 2-bedroom apartment there can rent for as much as $4,385 a month. That's over $52,000 a year just in rent.
Wow. So the very people the city relies on, police, transit workers, sanitation workers, teachers, are priced out.
Exactly. And that poses a fundamental risk to the city's long-term economic and social health. If essential workers can't afford to live reasonably close to where they work, how does the city function? It vividly shows the scarcity and demand that make urban real estate such a powerful investment asset, while simultaneously highlighting the significant social tensions it creates. Hashtag outro. Final takeaway and provocation.
Okay, we have covered a lot of ground today. From the internal disciplines of mindset and persistence, to the external analysis of markets and assets, the leverage and tax angles of real estate, and even the historical and urban context that shapes it all.
It really underscores that building significant wealth isn't about just one thing. It's a dynamic interplay. Mindset, financial literacy, asset strategy, they all have to work together.
And woven through all of it, whether you're buying a stock, negotiating a lease, or structuring that 1031 exchange, is the skill of negotiation. Persuasion.
Absolutely. Every interaction where value is exchanged involves negotiation. And one of the final takeaways from our source materials was about effective negotiation strategy.
It wasn't about overpowering the other side, was it?
No, quite the opposite. Successful negotiation often involves gently guiding your counterpart, making them feel like they are in control, maybe even doing the work for you, while you subtly define the boundaries in terms of the discussion.
Giving them the illusion of control. That's interesting.
And related to that, pay very close attention to language in these deals. The sources warned about a specific phrase when your counterpart says, "You're right."
You're right. That sounds like agreement.
It sounds like it, but often it signals the opposite. It can mean they aren't actually invested in the idea, they don't truly buy in. They might just be saying it to appease you or move the conversation forward without any real commitment. Be wary of "you're right."
Okay, that's a subtle but important cue. And there was one other phrase highlighted as particularly dangerous, especially when you hear it from yourself or someone on your team when discussing executing a plan.
Yes, the phrase "I'll try."
I'll try. Why is that so problematic in this context of definite plans and burning desires?
Because "I'll try" implicitly contains the option of failure. It suggests a lack of full commitment. In the context of pursuing significant goals, "I'll try" often really means I haven't fully committed and I reserve the right to quit when things get difficult.
It lacks that unwavering persistence we talked about earlier.
Exactly. So that's the final thought, the provocation we want to leave you with today. As you work on defining your own financial path, maybe you're analyzing an investment, maybe you're thinking about buying that first rental property.
Ask yourself,
hmm
what recent decision have you made or what plan have you discussed where the response, maybe from yourself, maybe from someone else, was, I'll try.
And really dig into what that hesitation truly signals. What does it say about the level of commitment to executing that definite plan? Because making that mental shift from merely trying to definitively doing, that's often the difference. That's the mindset that truly defines the path to wealth.